Welcome to Lesson 4, Cash Flow Management. You may be wondering, why is it that we already talked about cash flow and the cash flow statement, and now here we are spending an entire lesson talking about cash flow? Well, throughout this lesson, you'll find out why we spent so much time talking about cash flow and its importance. Cash is king or queen, whichever one you prefer. It is the top of the top. Cash is the energy that keeps your business flowing the way that electricity powers up the lamp. Without cash on hand, you will not be able to pay essential expenses, even while the income statement says that you're earning a profit. So it's important for you to know that even though the profit and loss statement or the income statement say, hey, there is a profit here, you may not be able to pay for your expenses because cash has not been received or is not readily available. The success of the business, therefore, is dependent on cash from the moment the business starts through its entire existence. Managing cash flow is more critical than managing sales, because sales without cash receipts lead to a failing business operation. Managing cash flow must be a core competency of the small business owner. The balance sheet tells a compelling story. A cash flow statement continues that story. So therefore, it is important that you use it to monitor projected and annual income and expenses. Understand that the cash flow statement is also the one that helps you identify variations due to seasonality, variations due to product shortages or material shortages. The goal in understanding cash flow is maintaining a rapid conversion to cash, converting your sales quickly to cash. So it's really important. Developing cash forecasts are also important. A business can be earning a profit and be forced to close, because it runs out of cash. If the business is owed money, which hasn't been paid. Managing cash effectively requires looking beyond the bottom line and focusing on what keeps the company going, which is cash. So it's really, really critical, at least from my perspective, that you understand the management of cash flow. One immutable law for keeping a business going is thou shalt not run out of cash. If your cash balance drops to zero, you can't meet your payroll, pay your creditors, buy materials, buy inventory, etc. Your employees may quit, your vendors will not sell you product, your creditors will pull the plug on the business. You just can't afford not to have cash or cash flow surprises. Somebody has to keep an eye on the cash flow. You cannot put them on automatic pilot. You cannot ignore them. So to start the business, you have to raise cash to invest in the assets that are going to be needed in order to run the business, supporting the sales and carrying day-to-day operations. Profit then starts when you start making sales, and hopefully you have developed a business model where it's beyond break-even to where profitability is going to come into play, right? So oftentimes the business is going to tap into both equity and debt in order, as a source of capital, in order to get the money that it needs to get the business going. An ongoing business also is going to need capital resources in order to finance its operations. Again, both equity and debt. An ongoing business depends on a third source of cash flow, and that is profit, right? Profit is our internal source of capital because the business doesn't have to go outside and get external sources for this money. Profit is one of the three main cash flow tributaries, right, that feed into the river of cash for the business, of cash flow for the business. All right. So this is some of the things that I've talked about before. A startup company must have enough cash to survive, right? The depth and breadth of what we call the valley of death, or it will become, unfortunately, just another failed business statistic. So what do I mean by the valley of death? Well, this is what you see on the lower axis, on the horizontal axis, is kind of the timeline of the existence of a business. And then the vertical axis is going to show the cumulative cash flow. So research and development is usually how we start a business, kind of researching, is this business viable? Is there a need? Is there an opportunity? Prototypes of the products or focus groups for the services, trials, all that good stuff, right? All that stuff we talk in the entrepreneurship class. Then eventually we identify, yes, there's a need. Yes, there's sufficient customers. Yes, I have a viable product. I have prototypes. I have, actually the product that I'm going to sell, and I begin to sell it. So there's a product launch or a service launch. And then guess what? It is the awesomest product or service there is, right? Everybody wants it. Everybody needs it. Everybody's craving it. Everybody is seeking me out for my product or service. And my business explodes. It is in that moment where cash flow is at its lowest, because I started out with startup cash, right? Whether it was through debt or equity. I began using that cash for research, for development, for product launch, for marketing, for advertisement, for promotions. And now I'm not generating any sales yet, right? So I'm running out of cash, and all of a sudden I get sales, but in order to continue to meet demand for the product or the service, I need more money than what the sales are bringing in, right? So all of a sudden there's this death of cash, right? That's what we call the valley of death of cash. And unless I understand kind of when that is going to happen and how that happens, I won't be able to get out of the valley of death cash flow. So good businesses that are foundationally sound and whose owners understand this particular diagram really well, are able to understand that I'm going to hit that. I'm going to have some reserves. I'm going to have some other resources that can make me get through it. And heck, I'm going to start taking off, and then the cash flow is going to start taking off as well, right? But if I don't have the planning, I don't have the awareness, I don't have the knowledge, I don't have the understanding, I'm going to die in the valley of death. My business will die in the valley of death. So cash and profits are not the same, and I want us to have a bit of a discussion about that. When we say sales revenue, we think collecting money from a customer. When we say expenses to an owner, thinks I'm writing checks to someone for the cost of running the business. So when we look at the income statement or the profit and loss statement, we think that that is equal to the cash flow for the business, right? But that's not necessarily true. Profit is the difference between the business's total revenue and its total expenses. Cash flow is a measure of a company's liquidity and its ability to pay its bills and other financial obligations on time by tracking the inflows and outflows of cash into and out of the business over a period of time. Two different measurement criteria. The sales or revenue amount in our profit and loss statement for the business or income statement is different than what we've actually collected in cash from customers during the month, during the quarter, during the year. Unless the business is all cash sales or credit card sales, which it could be, right? And then those would be the same. But if by any for any reason you have a service business, you're a landscaper, you are a painter, you're an electrician, you're a plumber, you are a architect, you are a HR consultant, like I was, a professional development consultant, you're operating on credit. And what I mean by that is that you are providing a service, and then after you've completed the provision of that service, you're receiving payment for the service. You may receive maybe half or a quarter of it up front, but the remainder of it is paid after the completion. So you're not a cash only business or a credit card only business. You're a business that is generating sales after, or generating cash after the sales, long after the sales have been completed. So the expense, and also the expense amounts on that income statement or the profit and loss statement are different than the total amount actually that has been disbursed for the month, for the quarter, for the year. There may be a delay because remember, we want to collect fast, but we want to pay slow, right? We want to take as long as we can. So in short, when we're discussing profit and cash flow from profit, we're talking about two different things. We're talking apples and oranges. So, for example, suppose that a business doesn't collect a dime of its sales revenue. It extended long-term credit terms to its customers, and none of its customers made any payments to the business by the end of the year. Assume, however, that the business paid all of its expenses during the year. Therefore, cash in equals 0. Cash out equals $27,000. So the cash flow from profits is a negative $27,000 for the year, despite showing a profit of $100,000, right? Because you have had sales, net sales in the amount of $100,000. You haven't collected any of those because you sell them on credit. But in the meantime, you've spent $27,000. So your cash flow in has been 0, your cash flow out has been $27,000. You're in the hole for $27,000, right? And so potentially the business hasn't made any money, even though the profit and loss statement says that you have. Suppose that the business instead collected all of its sales revenue for the year. However, it has not paid a dime in expenses yet. Its vendors, its suppliers, its employees agreed to wait for payment until next year. Highly unlikely, but we're going along with it. Therefore, cash in equals 100,000. Cash out equals 0. So the profit and loss statement, the income statement is going to say, hey, we made $100,000. That's our, net profit. Not really, because you haven't paid anybody for any of your expenses, right? The balance sheet would tells us that there's wages payables and that there's accounts payables. But the income statement is not going to tell us that. That is why I said earlier, the balance sheet begins to tell the story of cash flow. The cash flow statements completes that story. So for a proposed business, the focus is on its ability to generate positive cash flow in the shortest possible amount of time. Again, the goal is cash flow, not profitability. Profit, by all means, profit is desirable, but what pays the bills is cash. So I can have a profit amount show up on my income statement, but until I show that cash amount on my balance sheet or on my cash flow statement, I'm not too happy just yet. So in the financial statements, a business cash flow from operations is what we call EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. The EBITDA equation equals net earnings plus interest plus taxes plus depreciation plus amortization. Okay? So when we're thinking about EBITDA, that's what we're thinking. That's what we're talking about. Here I show kind of this cycle that cash flow follows in a business. We receive cash, and cash is decreased when we have accounts payables, we have vendors, we have creditors, We have material we have to buy. We have that we pay over a period of time. We make cash purchases for production purposes, right? We make cash purchases for inventory. There's a leakage, kind of shows and means that inventory sometimes walks out, disappears, it's unaccounted for. But hopefully, right, I have cash that I've converted into inventory, which then is generating cash sales when I sell that inventory, and also hopefully accounts receivables when I sell inventory on credit. And that also creates leakage, because think about it, sometimes the vendors and the customers, don't pay on time, don't pay at all. And that brings cash back into the business. So this is kind of the cycle that cash flow follows in a traditional sense. 3 views of cash flow that we would want to be aware of and that we would want to follow. All right. So cash conversion cycle, cash flow diagram, and the cash flow statement. The cash flow statement is what we're going to look at last. A cash conversion cycle consists of 3 components. The business pays for raw materials, business makes for products or delivers a service using those raw materials, and the business sells their product or sells their services. The trick is to know how long it will take to complete the entire cycle, right? The rate of conversion of going through the whole cycle impacts how quickly we get cash back into the business. If you have a very short cycle, great news. You buy inventory, buy raw materials, convert it into inventory, sell that inventory and turn it back into cash quickly, puts money back into the cash flow statement, great news. If you have a long cash conversion cycle, you will not be able to use the money while inventory is sitting in your office, in your warehouse, in your storefront, whatever it is that you have. Then you have fixed assets, which are usually expensive: building, equipment, vehicles, computers, technology. If you purchase an expensive fixed asset, that ties up cash, whether it's in the form of having to pay up front or having to pay more over time. There's the profit generator, which is the sales pump at the very top. If we keep that sales pump going, we're constantly pumping cash flow back into the system. There's the accounts receivables bucket. So you may make a sale but not receive your cash until later at some point. Ultimately, you want to convert accounts receivables as quickly as possible into cash. So it flows into the center of that tank where it says available cash. Some accounts receivables will never be paid. They will become, bad debt. Some of them, you'll have to either hire a collections agency or hire somebody to try and collect on that money. If you are unable to collect on the accounts receivables after 90 days, then the assumption has to be made that that money is never going to be collected. So when you create or you choose to offer accounts receivable, credit to customers, you have to consider the possibility that this will happen, and you have to consider the impact that this may have on your business. On the other hand, you have accounts payables, and that's in the center tank there, and we show it up as grids, or really we wanted it to be bricks. This is money owed to vendors and suppliers who have extended credit to us as the business owners, but we have yet to pay for those services or for those products. We still have use of that money as long as it's in the available cash bucket, but at some point, you're going to have to pay, right? So the bricks elevate the water. Instead of having to pay for a product or service, you can use that money for inventory or for marketing or for other bills that you may have to pay. So it's a balancing act, and it's one that you have to be careful with, but it's something that once the available cash is there, you can kind of have some flexibility. It is challenging to balance accounts payables and accounts receivables. You, again, want customers to pay quickly, but you want to be a customer that pays slowly, right? So you want quick inflows, slow cash outflows. Ultimately, you want to have and generate excess cash flow from profitable operations. So the goal is excess cash flows from profitable operations. The shower head that you see there represents your paycheck, right? So that's the excess cash flow from profitable operations. The broken pipes represents how depreciation can be used to reduce your taxable income. I'm not going to go into that because this is more for the accountants to know. But again, this is a diagram whose the goal of it, which is to give you a visual of what are the things that impact cash flow in a business. So what are the sources of cash inflows and sources of cash outflows? So accounts receivables are inflows, cash payments are inflows, income from investments are inflows, or borrowing money, incomes from loans are inflows, right? Outflows are payroll, utilities, loan payments, rent, insurance, taxes. Those are all things that we have to pay out and therefore impact the cash available. When we think about cash management, we think about forecasting. How much cash are we going to have? Collecting the cash, dispersing payment, paying the cash, investing the cash, and we have excess cash available, and planning for when the cash flow will be at its lowest or non-existent. When is it going to be at its highest, and what do we do with that? So it's those ebbs and flows of the business that we have to plan for. The Small Business Administration recommends that businesses have enough cash on hand to cover at least 6 months of operating expenses, right? So I will repeat that because I think that it's an important piece of advice that they offer. 6 months. The Small Business Administration says, hey, you should have 6 months of operating expenses in cash just in case. However, the reality of it is that many small businesses don't even engage in planning their cash flow. 68% of small businesses perform no cash flow analysis at all. And that is why, potentially, the rate of failure for small businesses is so high. It's because this is an area where they really don't focus on it. They really don't see, not much time is spent on it from the perspective of a small business owner. And it should be. So in recent surveys, at least 50% of small business owners report experiencing cash flow problems of some sort. So what are some of the most common types of challenges they encounter? Receiving payment or collecting payments. Cash flow, ins and outs, kind of when is the cash flow in, when is the cash flow going out. Managing and moving funds. Making payments, so those accounts payable side of the house, and understanding how much cash they really have, right? And there's a variety of reasons and ways in which that can be prevented, but are things that you as the small business owner need to be aware of. So, first step in managing cash more effectively, understanding that cash flow cycle, that time lag between the time when you're paying suppliers and employees for merchandise and receiving payment in return from the customers who sell the product. Cash forecast is a cash map. It's kind of showing the amount, the in and outs firm's cash receipts and cash disbursements over time, right? It's predicting the amount of cash the company is going to have and need in order to operate the business smoothly. It's all about focusing on what does my roadmap look like? 3 months from now, am I going to have sufficient cash? If not, then what's the plan for managing and having cash available? A helpful tool for visualizing the firm's cash receipts and cash disbursements and the resulting cash balance is what? What do you think that? Right? The cash forecast, right? It allows the business to make management decisions about their cash position, their cash reserves. Will show how much cash is coming into your company and the way that it's being used. It also will demonstrate seasonal fluctuations. How does the business come in and out? What are the fluctuations that we see in cash? And then allows you to create a plan for when you will need cash. It will help you assess whether there are periods during the business cycle when you might need short-term borrowing. It will also help you assess long-term, if I want to grow, if I want to expand, if I want to add another product line, then what are going to be my financial needs. Are going to be my net cash needs. So how do I prepare a cash forecast? Determine what is the minimum cash balance for the business that you'd like to have. Some business owners say, I want to make sure that every month I have $5,000 in cash balance. It's a must. And whether I make that through the earnings, the sales and the revenues that I generate, or whether it's a combination of sales and revenue and a line of credit, right? That some months that's the way it has to work. Either way, I want to start the month each month with 5,000. Forecasting sales. What do I see as the sales forecast? Forecasting cash receipts. Remember, sales does not equal cash receipts. If I'm selling products on credit, then there may be a trend that some customers pay 30 days after the sale, 60 days after the sale, 90 days after the sale. That is how I should forecast my cash receipts. And then lastly, forecast my cash disbursements. Because again, I may not pay my suppliers immediately. I may pay them in 30 days after receiving the product, the materials, the inventory, 60 days or 90 days. It's just going to depend, but I need to plan for all that. So how do I determine a minimum cash balance, right? That's cash on hand. What is in our checking account as a business? What is in our savings account as a business? What is on petty cash for the business? And any other cash accounts that you may have. The most reliable way of identifying what is the right minimum cash balance is based on what your past experience is. And granted, as you start up, you're not going to have that data, but after a year of business, you should be able to clearly articulate and know, based on your past 12 months cash flow statements, what should be my minimum cash balance to get me through each month. Forecasting the sales, it's just looking again at historical data, right? Sales are usually converted into cash receipts and cash disbursements. So cash forecast is only as accurate as that sales forecast for where it comes from. And again, if you're a startup, you may not have very accurate sales forecast. You may have to use industry averages for sales for businesses similar in size to yours, in a similar location, similar industry. But after the first 12 months of operation, you will need to have, and that's what we talked about earlier in a different lesson, a good method by which you forecast what your potential sales are going to be. Historical data will be your best friend, but other trends will also impact. Historical data of sales, for example, in 2006 would have said that the year 2008 would have been a phenomenal year, right, for businesses, but it was not because of changes in the due to the financial crisis. For a business that started right, that started right before Amazon kind of came on board, their sales may have been historically really well until now Amazon has taken some of that business away from them. So it's just going to depend. You're just going to have to rely both on historical data, industry data, and a good understanding of what are the external factors that may impact your business financial forecast. Understand that some businesses will have lumpy or seasonal sales forecasts, right? 15 to 18% of wine and spirit shops' annual sales occur between December 15th and December 31st. It's a huge amount of sales for a business. It's a significant chunk. So they have to understand that that's when they're more likely to have their sales. 40% of toy sales take place in the last 6 weeks of the year. So if you're a toy business or a business that is closely aligned with toy sales, that's going to be important to know. It's going to be important that you're going to prepare 3 sales forecasts. The most optimistic sales forecast, let's say that you think that's 20% growth. The most pessimistic, meaning that there's going to be 2% growth, and then somewhere in the middle, more likely, maybe there's going to be a 5% growth, right? So you're going to, again, need your accountant for this, but the accountant is not going to know your business the way that you do. They are not going to know your industry the way that you do. They're not going to know certain aspects about the business that are going to be critical for you to know and for you to work with them in establishing those forecasting numbers. Record all cash receipts when the cash is actually received. We call that the cash method of accounting. And then determine the collection pattern for credit sales, and then add cash sales, right? If you're offering credit sales, obviously. You got to monitor slow orders. They become crucial. The collection patterns are important to understand. So after a base level of accounts receivable is established, it has to be adjusted to reflect what actually happens, right? So it might be to assume that 90% of the accounts receivables will be collected within a quarter in which the sales occur. 9% will be collected in the following quarter, and 1% are going to have to be written as bad debt. Obviously, historical data will be the best indicator to help you make those adjustments. So here's kind of some information on probability of collecting accounts receivables and how as time moves. At 3 months, you're only looking at about 72%. By 10 months, you're only looking at 28.4%. So significantly decline in the possibility that you're going to collect. So forecasting cash disbursements, record them when you expect to make them. Start with those that are fixed amounts due on certain days of the month. Review that checkbook to ensure that you're looking at actual numbers, right? And that you're keeping good track of when the money is coming in and when the money is going out. And then always have kind of a cushion, right, for anything that could go wrong, right? You have an additional expense that comes up or something that you weren't thinking about. So what are the goals of cash management? Well, increase the speed at which you're getting cash into the company, slow down the speed at which you're getting cash out, and make the most efficient use of the cash that you have available. Take any advantage. Identify what are the sources of money saving opportunities, cash discounts that the vendors offer, anything like that, and take advantage of that. Finance seasonal business needs. So if you know that your business is that liquor store that sells 15% of its sales between December 15th and the 31st, then have a line of credit in the month of December to purchase the inventory rather than use the cash that you have available in the business, right? Because the line of credit will give you time frame to maybe pay that line of credit in January. Well, now your sales have happened and you can pay back the money that the line of credit afforded you. Develop a sound borrowing and repayment program. Have a way to impress lenders and investors. Provide funds for expansion. Plan for investing the extra cash. I know cash is king, but sometimes you want to keep that cash making more cash for you, not just sitting in a bank. Big three of cash management: accounts receivables, accounts payables, and inventory. So these are the three most important accounts to look at when trying to manage your cash flow efficiently. This is what we call the cash conversion cycle, right? So the length of time required to convert inventory and accounts payables into accounts receivables and finally back into cash. That's what we mean by the cash conversion cycle. So accounts receivables, we've talked a little bit about this already. One of the most vulnerable areas of vulnerability for a business, because it can be an area that if you don't keep an eye on, you lose track of, right? So think about it. I am a landscaper, and so I go and I do landscaping, I mow lawns, I cut trees, I plant flowers, I do projects. I may have 15 projects going on or 15 clients that I'm servicing. And if they're paying me once a month and I'm not constantly looking at who's paid and who has not, I could lose out on money, right? Because I'm not collecting on the money as fast as I can. So I got to develop some kind of a system that's going to work for me and for my business if I'm going to offer credit. Establish a clear policy. What is traditional? What is the norm? What are other businesses such as this one doing in order to establish payment practices, collection policies? What is going to be my credit granting policy? Again, we don't think of establishing these before we start the business. We don't think of them usually during the first 6 months, 8 months, 9 months, sometimes a year of the business. We think of them when the first set of customers don't pay, right? When those to whom we've extended credit, we've done work for, and now all of a sudden we find ourselves in the situation where they're not paying, right? It is also important that as the business grows, you're potentially going to be interacting with customers that have that are bigger in size, that have maybe their own established policies where they have established as a policy that we don't pay any of our vendors unless it's 45 days in arrears after the project has been completed, right? Or after they've invoiced us. So now you know that I'm not going to get paid after 15 days or 30 days. I'm going to wait at least 45 days to receive that payment. Am I going to be okay with doing business with that type of customer? It's important that you identify the credit worthiness of your customers, right? It's important that you have the customers complete a credit report before you provide them with any services. So have them provide with the name of other customers or other vendors they do business with as references, and check what those references are. Do they pay on time? Do they pay 30 days late, 60 days? 90 days? What is their payment history? Have they been consistent on it? If you're going to extend credit to customers, just like somebody would check on your credit to extend you credit or give you a loan, you should be doing the same as a business owner. Accounts receivable. Well, some of the techniques that you can utilize is include a description of the goods or services that were purchased. Send invoices as soon as goods are shipped or services rendered. In my consulting practice, as soon as my project ends, the day it ends, I have it on my calendar for me to go ahead and send that invoice, because I want to make sure they get that invoice as quickly as possible with intention that they will pay that invoice as quickly as possible. Highlight the due date, balance due, and payment terms on the invoice. Restrict customers' credit until past due bills are paid, right? Don't extend additional credit. Deposit checks and credit card receipts daily. So if you are cash only or a business that accepts checks and credit cards, process those as quickly as possible. Don't let that cash or that check or that credit card transaction sit idle. Process them. Identify the top 20% of your customers who have late payment trends and keep an eye on them, right? Or pay somebody to do that for you. If you are a project-based, service-based type business like mine is, for example, I ask customers for 25% up front, and then they pay the remaining 75% at the end of the project or at the end of the engagement. Sometimes I've done it where they pay as they go, so we break the project into sections, into completion outcomes, and then after each completion outcome, 25% or 30%, whatever the amount we agree to, is paid. That's another way to keep cash coming in. Develop relationship with customers, accounts receivables payments. Oh, I can't tell you how many people I know in businesses in the accounts payables department, because they sometimes became my best friends when I needed to understand, okay, where is my payment? How much longer? Have they submitted this? What else do you need from me? Those are all become important. When the account becomes overdue, don't wait. I know it's hard. This is one of those hard things in being a small business owner. You are the person that wants to be pleasant and nice and kind and offer solutions and sell them more product or sell them more services. But unfortunately, if it's just you, or it's you and maybe a couple other people, but you're the owner, you're the founder, you're the one that's collecting too. And wearing both of those hats, it can be extremely uncomfortable, but there's no other option. Track results of your outcomes, right? Good customers will expect to pay their bills within 5 to 10 days after their due date. Bad customers will pay only when they're forced, right? Even if they have the money. And at some point you have to evaluate, do I want to keep a bad customer? It's just something that as a small business owner, you get the opportunity to evaluate and the opportunity to do. But also you may have, again, as you grow, as you become better known, there's going to be potentially bigger businesses than yours that are going to already have established accounts payable policies that say, well, we don't pay any invoice until after 30 days of receipt or after 30 days of engagement ending. And so those things you're going to have to account for as you go through these policies. A couple of ratios that help you as an entrepreneur, as a small business owner, understand whether your accounts receivables are good. We talked a little bit about this in ratio analysis. I'm rehashing it here to kind of highlight for you why it is important to understand this ratio. Is days receivables, right? Number of days it takes your business to collect accounts receivables, or the number of days on average that it takes the business to convert those receivables into cash. So outstanding receivables divided by annual sales, which are divided by 365 days, a way in which you can identify that. The lower the receivable number, the better. But the best way to understand whether or not your receivables are in line and in check is to check them against industry averages and make sure that they're not above what the industry averages ratios say about days receivables. Ideally, businesses will collect all of their receivables quickly, again, well, stretching out their payments to their vendors without damaging their credit. Make sure you check all invoices. We make mistakes. People make mistakes. Don't overpay, right? Negotiate the best possible terms for your business. If you know that you're going to need a certain amount of product in order to do projects that you do consistently for customers, then go to that vendor and say, hey, I use 100 pounds of X over the period of 6 months. Can I get a better rate for that product from you? Because I can guarantee you that in the next 6 months, I'm going to buy this 100 pounds from you, right? So those are the kinds of things that as a small business owner, you got to start thinking about. You got to be honest with creditors about, avoid the check in the mail is in the mail syndrome. You wouldn't want a customer to do that to you, and you don't want to do it to somebody that is providing you with their services or with their product. And then schedule those things that you can control. If you can make, maybe not the electricity bill, but the credit card bill hit at a different time of the month than the lease payment, then make that arrangement, right? Kind of play around just like you kind of would do with your personal life. Something to definitely think about and something that you should consider. And last, let's talk about inventory. Got to monitor that inventory closely. It can drain a company's cash because why? It can walk out or we can overbuy. Again, one of the businesses that I do some consulting with, small business, it's a clothing boutique. And one of the challenges, one of the things I always challenge this particular customer of mine is, are you overbuying? Do you have more inventory than what you will be able to turn over, right? Because what ends up happening is that because one of the things that ends up happening is that once you convert that inventory, once you buy that inventory, your cash is gone, right? The actual cash available is no longer available. So unless you're able to quickly turn over that inventory, you're not going to have cash available. So that's kind of the balance is in a boutique like hers, you want to have sufficient enough goods for people to come back time and time again and be interested, but you don't want to have too much that's tied up in inventory, right? So you can arrange for inventory deliveries at the least possible date. You can negotiate quantity discounts if it's something, again, that you buy in large quantities. Consider having suppliers that maybe can make fast, frequent deliveries. You can mark down items that are not selling in order to move them out of the floor and get some cash value for them. And again, the same quantity discounts, cash downs, all those things that would be available. Cash gap. We talked a little about the valley of death. The cash gap is similar. And what here you have to think about is when is the money going in versus when the money is going out. You deposit a check today in payment for some goods. You typically do not receive the cash immediately upon depositing. There's a float time, right, before the time the bank kind of checks that there's sufficient funds in that account before they go ahead and deposit it into your account. That's what we call the cash gap. And you as a business have to be aware of that cash gap. So in order to reduce that cash gap, increase the number of days it takes to pay for inventory, decrease the number of days it takes to collect receivables, and increase the inventory turns. Those are the ways in which you can help that cash gap. So I give you some examples here that you can do that. Each one of those, increase the days payables up to 2 weeks. Vendors, other businesses will allow for invoice payment. Decrease the days of receivables. Most e-commerce retail businesses that receive immediate payment upon their sales taking place may have no receivables, right? On the other hand, construction contractors and consultants usually don't receive payment until after the work is completed or service is finished. So put it in that agreement that it's due within 10 days of completion, right? And hopefully that decreases the days receivable. Increase the inventory turnover. The faster a business can convert its inventory into cash, the less of the cash back gap that will exist. So that will become important. So where do I find cash available, right? To increase your cash, you could increase the amount of sales, right? So sales is one of the, if you open up that pump, if you keep it moving, your cash is going to increase because you're going to have more sales. You can always increase the price, right? And so the pump may move fast, but if you increase the price, now the amount of cash, the water that's coming into the bucket, it's going to increase just by the nature of the increase, hopefully in sales, with the in addition to the increase in price. Reduce your expenses. When we looked at that diagram, you looked at that there's, stuff that takes money from water from that bucket, right? So how can we manage those expenses and reduce them so that I get to keep more cash and have more cash available? Changing the timing of my expenses. Can I wait to pay or buy for something, buy inventory, or can I wait the time or change the timing of when my payments are due? Save money, right? So when I have my seasonal months, I keep more of the cash flow that I made, and I put that away to get through the months when I don't have as much sales, right? My seasonality is off. Obtain sources of cash other than sales, right? So think about line of credits, credit cards that are in the business's name, not yours. Those are all ways in which you can have access to cash other than the sales coming in. Reduce or change timing of owner's draw, right? So when do I take what I would like to keep for myself? I may have to shift that. So instead of me getting my profit after taxes at the end of the year, maybe I get it at the end of the first quarter, right? So just changing that, because I know that at the end of the year I may have some expenses. The next 3 months will be hard months for sales numbers. Buy inventory from vendors that offer it at a lower price. Obtain credit from those vendors. Sometimes vendors will float you the money, right? Meaning that they will sell you the product or the materials or the inventory and tell you you don't have to pay for it for a certain period of time, or they'll be the financial institution that lends you the money, right? Make sure it's on favorable terms. And then establish good, sound policy to ensure that customers understand what your collection practices are. And hopefully that will encourage them to pay you on a regular basis. That is more consistent or quicker. The turnaround would be quicker.